All right, today is Monday, November the 6th. I'm back. Now. Officially, I'm not back with anybody. Right? I've left TD Ameritrade. We all know that. I've left InvestTools. That was a few weeks ago. Officially last week. So now I'm just kind of on my own. I'm doing this market outlook video just on my own here. So I'm glad that you're watching. Make sure you let me know that you found it useful by clicking that thumbs up down there on the YouTube channel, as well as liking the tweet. If you found it through the tweet, make sure you like that tweet and retweet it if you feel like other people should be checking this out now as well. So again, I'm on my own. Brandon also left at the same time. Most of you know that Brandon also left at the same time. He and I are working together, putting something together that we feel is a good alternative for those that are seeking premium investor education. But we know how important it is to get your input and not just do what we assume is best for you, but getting your input on what you want and what you feel like you need to help you achieve your investing goals and get the most out of your education you possibly can. So we don't want to do anything without your input, and we have built a survey. You'll see the link in the description of this video down below. We want to hear what you think, what you want, so we can make the best product possible for you. You'll also see there's a link to join an email list in the description video that will let you keep you up to date on any changes, anything developments. We're going to spend this kind of next couple of months working to build a good product for you that we can start to put together here later. So you want to stay in tune with us and know what's up to date. Of course, I'll be doing videos like this every day. Brandon's back to doing some of the things that he's done in the past. You'll be able to follow him on Twitter. You follow me on Twitter. Most of you already do. But you can also follow him on Twitter at Brandon Van Z. You'll see him there. So make sure you're following both of us. Make sure you subscribe to our email list in that description. And like I said, fill out that survey. Let us know what you want us to deliver for you, so that we can hit the ground running next year, early next year, and really deliver the best possible education that you need to help you achieve your goals. All right, with that said, let's go ahead and take a look at what we expect the market to do using the S&P 500 here. Looking at the S&P 500, as you can see, using the Thinkorswim platform. Just like all of you probably are still using the Thinkorswim platform. We're on the charts here looking at the market forecast indicator, which again is within the studies, one of the many available studies you have on this platform. You can see, for those that are new, as you scroll down, you got market forecast listed in there and market sentiment, which is in alphabetical order. And you can see it right there. Those are the two indicators. You can also use this on the TOS charts. We'll get that set up eventually. For now, I'm just going to stick with what I've always used here on the profit charts. But we'll take a look. You can see the posture continues to be strongly bullish. Has now been strongly bullish since, the end of August? So we're looking at now 2+ months of a strong bullish posture of the intermediate line crossing up above 50. Which that signals the new intermediate trend. You can see it happened over here, and it's been taken off ever since. We are getting closer. That we're slowing down a little bit, and and you'll see that the ranges are getting slightly bigger. Not today's, but the recent ranges has been getting slightly bigger. We're still above this upward trending moving average. I've got the intermediate trends Fibonacci retracement set up here, which actually needs to be moved higher, doesn't it? It's been moved up to there. And then I have the current near-term trend also set up here. We'll move that one up as well to account for today's move. There we go. So again, a near-term retracement to the 38% Fibonacci level essentially gets us to the old near-term high point, which is that one. And that's what the ovals represent, are old near-term highs and lows. You can see, we're getting progressively higher highs and higher lows. We avoided a divergence here by this new peak on the near-term line that just about got us a cluster. I mean, the near-term line Friday was at 79.5, so we were just almost there at another bearish cluster as we get further along. And again, the typical range for for the intermediate trends is 1 to 3 months. Longer, like closer to 3 months, when you're at the beginning of a market sentiment move higher, like down here, and closer to 1 month when that intermediate trend starts here. So again, like this is longer than what would be expected. Now, of course, it's like the weather; you don't always get what you expect, but you have to base your actions on what you expect, and then deal with the consequences when they come. Like, for example, we went to Disneyland on this past weekend, and we were there Thursday, Friday, Saturday. We were expecting rain on Saturday, so we had brought and we looked at the weather. There was sun. It was supposed to be sunny Thursday and Friday, and we were expecting rain on Saturday. So we brought ponchos, mainly because we're going to go down Splash Mountain with a 5-year-old, and to get him on there without getting soaked and other rides. So we brought ponchos and for the rain. So we expected that. We planned for it. Well, so we left the ponchos in the room on Thursday because we didn't think we'd need them yet. It rained on Thursday and not on Saturday. And so we didn't need them Saturday. We needed them Thursday, and we didn't have. So we kind of planned. We based, we tried to figure out what were our plans based on our expectations. And it didn't meet as expected, so we dealt with the consequences. Right, we were a little wet on Thursday, and we went on Splash Mountain quite a bit on the third day. So when we planned to have the ponchos anyway, it's the same thing here. We plan for the intermediate trend to last about a month. And you can see, we started okay. We had about a month there, and then we were kind of looking for it to kind of peter out in this area as we get closer to the month. But it didn't. Look at that strong near-term trend. I mean, it's still a bullish trend. It's still a strong posture, so you still ride that trend. And now we get a new near-term low point here. Now that we're close to 2 months in, we don't expect this one to last very long. Doesn't mean that it can't. I mean, again, a typical near-term trend lasts 7 to 10 days. Here we had 20 days or close to it. And it ended up with this bearish cluster. Not bearish cluster. Well, yeah, bearish cluster and a bearish engulfing pattern on there. But now we're in a new trend, a new near-term trend that's been above 50 now for what? 1, 2, 3, 4, 5, 6, 7. So we're kind of in that range. And we're above 80. So when you're above 80, which we crossed right about here, we don't expect a whole lot of upward movement. It doesn't mean it has to go down, but we just don't, the expectation are we don't get a whole lot of new growth. Like we got this growth to get us to 80, and now we don't expect a lot. And you've seen me talk about that in the past, where we look at those expectations. And eventually we're going to get we got a near-term pullback there that produced a new near-term low, which I've got the oval in green. Eventually we're going to get an intermediate term pullback. And whenever that happens, again, that's going to be the posture turning bearish. And you can see where the Fibonacci lines are, and you can see now, with this new growth, the 62% Fibonacci retracement happens to line up with the old intermediate high point. See, these oranges are the intermediate lows. So there's the old intermediate high point that happens to be in between those two lows. So this one right here, where you had a bullish posture. So interesting how this kind of lines up, and you can see there's your 50%. There's a last significant near-term low point there, and you can see the most recent one is right at the 23%. So you can see now if we do eventually peak in this area, based again on market sentiment being as high as it is, then if there starts to be an intermediate pullback, you can see where the areas of support are going to be, and they're going to line up with old near-term low points. This one here at the 23%, and then of course this one over here at the 50%, and then you have another old high. So look at all that support. So don't, and the fact that we've gone up so much, move back down to say 2,500, that's going to be a 100-point drop in the S&P 500 if we ever get that. And that would be to the 50% Fibonacci to that near-term retracement. If that happens, I'm guarantee you're going to see this doomsday posts, blog posts and articles on MarketWatch and whatever saying, now the market's tanking for whatever reasons. That's going to cause that pullback. But in reality, it's just a Fibonacci retracement of 50% where there's going to be a lot of support to hold it up. So if that ever were to happen, for those of you who watch these videos, that should be like cheering. We should be cheering that, because then that might bring the market sentiment line down low enough to a point where we can now start a new run, a new intermediate run higher. and have more potential gains going forward, because we've had quite a bit of a gain year to date. In the past 52 weeks, we've had quite the return. You know, we can expect. I saw something too where people were polled about what their expected returns are for the next 5 years, and they mimic very closely the returns of the last 5 years. In the last 5 years, we've had double-digit, close to 20% returns. Very, very strong returns on an average basis. And of course, with the VIX being as low as it is, and CAPE being as high, the PE ratio being as high as it is, we can expect the same kind of returns for the next 5 years. But that's people's expectations. And so again, we've had this kind of return here. We wouldn't expect this kind of return for the next year, mainly because right now, unless we had a deep enough pullback to bring market sentiment, this longer term line, down to a low enough level that a move up higher now would give us, potential energy that can be converted into that kinetic move. Or impulse move up to new highs, eventually back up to old highs, because we're going to get the pullback, but then eventually to new highs beyond that, just like really this one was back here when we had this market sentiment move. After such a multiple months of this sideways, we got the pullback before the election that brought the market sentiment line down because we were so flat and lower highs and kind of a descending triangle, and then that low point down to this level provided the boost to get up to the old highs and then some. And then of course we had a couple more pullbacks in market sentiment down below 70 at the very least, and that provided this move, and then this one provided this move. And again, we need to, from today going forward, we wouldn't expect the same kind of moves without that kind of pullback. And you notice every one of these market sentiment, you can see the intermediate posture was more bearish, for a couple of months there. Even though we were sideways, you can see what the intermediate posture was doing. And then there's that one that brought the intermediate line down below 50, that produced that dip, and then that one here produced this dip. So there's your buying opportunities. And once that happens, if that happens, because who knows, considering the way the market is, we might just go up every day from now on. But if and when that happens, we get that intermediate pullback. And if it happens to be down to some old, some deeper Fibonacci supports because of how strong the previous bullish run was, we're not going to freak out. We're going to look at that as an opportunity, like we've seen all these others, for new impulse moves higher to match those old highs eventually, and then of course move on to higher highs, because that's currently the long-term trend. Speaking of that, here is the long-term trend. You can see the MACD itself is almost up to that 110 high point that we had over here in March. This strong peak that we had, here we are again. You can see the ranges are getting smaller. We're starting to get longer lower shadows, which can be bearish. Obviously not as bearish as the long upper shadows are, so keep that in mind. And we're still kind of closing at the highs of the week, even though the lows of the week, are a little bit deeper. So that's bearish, because that means the bears were in here enough to push us down, but they weren't able to sustain it. At some point in time, if the bulls are unable to sustain their run to new highs, and the bears come down and finish the week low with a long upper shadow, that's bearish. Just like it is bullish on the other end of things when you get these long weekly lower shadows that tend to mark the top. You won't get as long upper shadows because the VIX will be lower, right? So you'll see that you'll start to get some long upper shadows like that one and like this one over here. You can see some longer ones showing up there, and you can see by comparison we're just not getting any of those longer upper ones yet. But strong bullish trend. And again, a pullback to 2,500 would break the 50-day, still wouldn't even sniff the 200-day moving average. So that's why we would look at it as another potential buying opportunity. As you can see here, you flirted with the 50-day moving average multiple times, well above the 200, before you actually flirted with the 200. And even then, after you flirted with it, you continued some bullish moves, not as strong, but you still continued that bullish trend until the middle of 2015. Take a look at the three green arrows here, the moving average, the MACD, and stochastics, and you can see we've got three green. We're bullish in all three of these. We're above the moving average. The MACD is positive again, so if you take a look at where it's at, it's above its moving average. That's why you get the arrow down here in the histogram, and then you can see also that the stochastic is in the reversal zone, but all three of both of these are setting up for divergences. They're still below the previous peaks, whereas the index is obviously up to higher highs. And that's why I said before that you can see the gap here between these moving averages and the price is smaller than it is here, even though we're up to new highs. It's slower. It's slowing down a little bit. But still bullish in the fact that all three lines are still in the right bullish order here. And I mentioned before, you won't bust down below that 30-day moving average until you start flirting with a 17-day more. And again, you don't break down and stay down below there until that MACD gets closer to zero, until both these lines start to converge, the red and the green, the 8 and the 17 starts to converge. So you'll see that MACD, continue this trend down to zero before you get a sustained bearish move that will at that point most likely get us down to a deeper intermediate pullback. The intraday move, you can see, produced higher highs and higher lows. We obviously got above the 4-week high. That is if you notice, the 4-week high is starting to, because we're slowing down, the upward move is slowing down. You can also see that now it actually has to be moved up here I had it one more day. So we'll move it up to the low on the 10th. And eventually, once we get past the 10th here, the low of the 10th, eventually we're going to have to move it to that low point. Which, let's see, the low point on the 25th, 254 even. This one is 253.98. So we're going to have to move it up 0.02 of a dollar, of a point. But that's the 4-week range. You notice that's only about 4.5 points. Excuse me. That's only about 4.5 points there. That's not much of a gap. So the gap is starting to shrink, and when it shrinks when it starts to close in, and then we get the reversal to the downside. We haven't had it shrink for a while because we've been moving up and up and up and up and breaking out to new highs. But since we've slowed down, since we had such a big range, and the volatility is getting higher, you'll see in a second, we had that big range here the previous week, and then there's last week's range, as you can see here. Last week's range, again, we're on Friday, we almost got that cluster on the S&P. We're trading right at the high, the 4-week range, and we moved up today a little bit to 259. So now we're looking at about a 5.5 point range. But like I said, we're going to eventually move that up, and eventually that's going to come off, and we're going to move up even higher. So in order to maintain a 4+ point range, we'll have to keep moving up higher and higher. But you notice, so today's range, if you take a look at the volume and the range, so the volume has been about average, about 50 million, even though the average is extremely low. It's been about average. So you can see over here it wasn't at 50 million as we were before we started to get this volatility, but we started to get some volatility. Trading ranges got bigger. You also see that today's range was 0.75 of a point, the volume at 49.5 million. So we'll look at that here, and you can see 0.75 of a point down low, but you see how it jumped up a little bit and starting to pull back down. And you can see the volume had jumped up a little bit too off of its average because those numbers got higher down a little bit today. But again, we're starting to we've been so small and so extremely low, and they're starting to move up. And you can see when they start to move up, we start to get some volatility, and that produces these move up to higher levels when we are going down. So we'll keep that in mind. Now you notice each peak on all of these is getting lower and lower and lower. So even though the actual index values are getting bigger and bigger, the average ranges are getting smaller and smaller. And you can see the low, this got so low here. And again, we're talking about an average range of 1 point on 250 versus way over here in 2013 when it was 1 point at 140. So that's a much smaller range on a relative basis. So we're getting really, really extreme. We've seen this before in 2006, 2007. We saw it in the mid-90s, which is this compared to a lot. And the market didn't tank after that. We actually went up to extreme highs in Case-Shiller and things like that with higher volatility in 98 and eventually in 99. And we already see that again. We see the Shiller-Cape ratio is already above 30. It hit above 30 in 97. And then again, we had a couple more years of bullishness. So not that we have to repeat what we've done in the past, but we've seen precedent for this not to necessarily mean we're going to tank. But you'll typically, like we saw even in early 2007, you'll typically see an increase in volatility before, and eventually, and that happened in February of '07. We hit the low point of volatility. We started to rally, and the market peaked in October 2007. So it was about 10 months of rally there. But with bigger ups and downs, with some more volatility and like I said, we haven't seen any volatility. And if you take a look at the VIX here, you can see the VIX it closed Friday at 914. That's extremely low. And again, even with a bounce up today, because it was a Monday, and usually we drop down on Fridays and bounce back up on Mondays, but you can see, how extremely low it is. Now, there's a new, someone mentioned to me, I think it was Butch that mentioned that the ratio, the symbol changed to VIX3M, so appreciate that heads up. I'll let everybody else know that as well. But that symbol changed on October the 23rd. So this chart is the VIX all the way up to right here where my cursor is, October 23rd, and now it's back to the ratio that we've come to understand, where the 90 to 95 area is the neutral zone, so to speak. Anything below 90, 85 is kind of the sweet spot. We're down to 73. This is, we have to, like, if I were to show this chart. So this chart is that VIX ratio all the way up to October the 23rd. So there's the last, 17th it looks like. That's the last data point we have. And now remember, 73, look at this chart here, and you can see how often we get down below 75 and stay down there. Here you go. You can see, look. 2012 we got down this low, and look what volatility did after it got this low. It jumped back up, not to extremes, but it jumped back up to normal pretty quick. This was in March of 2012. You can see there's March of 2012. And we were pretty bullish then, relatively speaking. We were at what? MACD was at 70 points on 1400. So that's about 5%, 70. Again, I'm using the MACD around 70, or see right here, around 70-ish for 1400-ish index. And then now we're looking at, we're at 8 at a 2600 index. Again, that's almost as high as we were back here and right here. And but you notice the pullback wasn't trend changing. It got us down to the 200-day moving average, which we haven't seen since before the election. But it bounced off of that and continued the bullish trend. So again, don't get too worked up if and when we do get a deeper pullback than we've seen. So now let's transition to what's driving the market here today. And it's been a while since I've done this. It's been a few weeks since I've done one of these videos. So I'm not going to take nearly as long on this section. But I did want to kind of go back to whenever I stopped doing this. So let's go back right around that October 15th level, October 16th, and see kind of what's done so well. This should jump right off the screen at you here. But you can see from the time that I stopped doing this, the biggest gainer right off the bat, and for the last little bit, has been crude oil. This is the ETF that tracks crude oil, up 11% in the past few weeks. That's quite the move, even with the dollar being up about 2%. You can see during the same time that the S&P 500 has been outpacing the small cap index. So not necessarily the most bullish sign when the dollar is outpacing stocks, and large cap stocks are outpacing small caps. Crude oil is outpacing gold, so that's bullish. You can see that treasuries are outpacing, and really because of a late little push here, treasuries off of this low point right there are starting to outpace from was it 26th? Are starting to outpace. There's treasuries outpacing high yield, and so a late push here. And you can see what that's done. Here's crude oil, and you can see crude oil in the last couple of days has broken through that magic $55 price level. If we were to zoom out a little bit more, you can see there's that 55 level. The next major support is around $60. If you take a look at TNX, we had broken up above 2.4% a couple of weeks ago. Things were looking bullish in terms of yields. And it was a false breakout because we've now continued back down to 2.3% here in the last 2 weeks. So that's that move higher on Treasuries. So you can see, we've really been fueled lately by what's going on with crude, and that was the big move here today. Crude oil up big, up 3% today. Emerging markets continuing to do well. That's been a recurring theme pretty much all year, has been the outperformance of emerging markets. Gold rebounding with a pullback in the dollar, but we know why, because that was down so much recently, and you can see treasuries up too. There wasn't much on the economic calendar today that's come out. Obviously, last little bit we've had the GDP numbers come out. Well, we've had the jobs numbers come out. You can see the new GDP estimates for the fourth quarter are starting off as strong as always. It seems like lately everyone started off at 4%. We've also talked about that this 3% number for GDP is a little, take with a grain of salt, because the most important part of it wasn't very much. And then, there wasn't much fixed investment either, which is an important part of the economic growth. It was mainly coming, the main part of the growth is coming from a lack of exports, or imports, which is not a good sign, and inventory growth, which is very temporary, and so it's oscillating. So take with a grain of salt that GDP growth, but the jobs number blowing out expectations, you can see pushed the economic surprise index to 40 now. It's, again, we haven't been this high since right after the election, with a lot of those sentiment surveys, not necessarily the hard data, which again, the employment number is not necessarily a hard data either. It's a sentiment. It's a survey number. But you can see that's the last time we've been this strong. So sentiment's building. We're kind of getting some strong hard data, but not really. I mean, some manufacturing data is increasing, but it's not turning into sales yet. Per se, that's been kind of slowing down here. So we'll take that with a grain of salt, especially considering markets at such high valuations levels can dampen expectations more. Does not necessarily reverses them and says, well, we got strong bullish trend, but man, this is telling us we should be bearish. No, it just dampens our bullish expectations, but still maintains some bullish expectations simply because of the technical trend. Alright, we can take a look again, same thing since my last video, how the sector rotation's been doing. It started off kind of a little safe haven, real estate, utilities, and you can see real estate, utilities is still doing pretty well, outpacing the broad market over the last 3 weeks. Of course, energy up 3%, not surprised there, but you can see where the market leadership is and has been lately. It's since the technology, sector, is up 5% in that time. Whereas on the other end of the spectrum, healthcare, real estate, consumer staples down 3.5%. That's not too often you see such a distinction. The market up 1.5%, led by some bullish sectors, technology. You see financials outpacing slightly, consumer discretionary underperforming slightly. But to see industrials and materials underperforming too suggests, again, grain of salt on the economic growth numbers. And to see consumer staples underperforming like this says that there's opportunity there. Like, again, the correlation for stocks right now is about as low as it's ever been. And which means that we're in a stock pickers market where, as we continue to move higher, you tend to get new things leading the way higher. You can see real estate and utilities led that surge, technology and energy leading this surge. So new things will lead different surges. It'll seem like different leadership day to day sometimes. But we know that eventually when markets pull back, when those correlations start to increase, when markets pull back, everything pulls back. And that's why those correlations start to increase again. And when that happens, typically, again, yes, consumer staples might pull back a little bit, but not as much because of how. Look at the distinction in numbers here, which again reflects how low correlations are right now. That we have to pay attention to which sectors are outperforming and ride those strong sectors for momentum, for growth, for trend trading. And look at these beaten down sectors for value opportunities if and when the market does start that intermediate term pullback. For our trade example of the day, I wanted to focus from a technical perspective on a stock in the news. Disney, as you can see on the screen, obviously in the news for potential buyout talks of 21st Century Fox, so not Fox, the TV channel, because Disney already owns ABC, and also not Fox Sports, because Disney already owns ESPN, so that obviously you can't. The two biggest competitors you can't merge. But the movie business is Disney's in talks to get the movie business, which some view as their competition with Netflix. So it was really viewed positively for Disney. But from a technical perspective, you can see low Bollinger bandwidth, which means that we've been in the sideways range, kind of basing out here at 97.5 roughly, breaking out above the upper Bollinger Band today. 3 green arrows, so breaking above in the sideways trend with a lot of volume. All positive signs and developments for a bullish trade opportunity. Now, again, not how bullish? Well, not too strongly bullish because we've been in the bearish longer term trend. We haven't broken out of this sideways range yet. The expectation is there because of the signals that we're seeing on these different indicators put together, but that doesn't necessarily guarantee anything. And we know that there's some strong support here. So we said, okay, well, what if we were to sell that 97.5 put and buy the 95? We'd get a decent probability of success. We know there's going to be some support right here. The break-even point is going to be below that support, which you can see here on the chart. The break-even down there. So now we'll know if it doesn't, whether this breakout holds or not. As long as the support holds, then there's opportunity to make money for this trade. You also have earnings coming out, and once that volatility comes down, it won't come down as much. Because you can see here, a lot more volatility in the week of earnings than there is past that. So it will come down some, and that will help a trade like this, which is bearish on Vega. It's got a negative Vega, which is bearish on volatility. So again, an example is to take advantage of a stock that's in the news, but because of that, has produced some really good bullish trade signals that we can look for a bullish trade example because, again, of how bullish the market has been and where the leadership has been in this kind of consumer discretionary technology area, which Disney hasn't necessarily taken a part of and now might be able to start catching up here. So in summary, the market trend's still bullish, still strongly bullish. It's getting, there's a lot of signs that it's mature, but that doesn't necessarily mean that it's going to drop tomorrow. We just have to be aware of that and know, okay, rain is in the forecast. And while it might be sunny from now on, despite the rain in the forecast, it might be partly cloudy and just not dropping. I live in Utah. There's a lot of partly cloudy days where you expect some rain and it never drops. So, rain is in the forecast because of how bullish we've been and how extreme some things are, like the VIX to VX, the VIX 3M ratio is. So that might mean we need an umbrella. We might need our ponchos, raincoats, and have them just in case. And if it doesn't happen, we're still going to go about our day doing what we plan on doing. We're still going to ride the trend. The bullish trend, just knowing that we need to prepare for rain if and when it ever comes. So as a reminder, thank you very much for watching tonight. Let me know that you found the video useful by hitting that thumbs up down below on YouTube. Let us know your thoughts about what we can do for you in terms of what kind of company we can put together for you with the survey link that I pointed out. It's also in the description below. Follow us on Twitter. Like the tweet with the video in it to let me know again that you liked it. And the way you can promote it is just hit that retweet button. Like I said before, you don't even have to have a lot of followers. Just the fact that you retweet it, Twitter starts to pick up on that and starts promoting it themselves to people that would appreciate that type of content. So retweet. I appreciate all that. Thanks again. Have a great evening. Sorry it went so long tonight. I'll keep it much shorter, I promise, in the future. Back to its normal range. Have a great one, everybody. We'll see you again tomorrow.